following is an update and technical analysis on natural gas futures displayed throughout the daily interval, and I believe we've reached a critical juncture within the technical structure of the spot price of the commodity down to the fundamental analysis, huge dimensional pivot points in my opinion, and we are dancing upon a potential breakdown sell signal off a minor reactionary uptrend price support level. And we took that key inflection point out. We have been in a consolidating range since, backtesting it multiple times off that key inflection point, only to be rejected in a slight counter trend weak bounce. And here we are trading around the spot price at 4.05. And we are within the definitive nature now on a confirmed, clear, bearish rising wedge pattern. We have negative and bearish divergences that have only continued to construct and establish on all four key technical momentum indicators with a confirmed bearish crossover within the moving average convergence, now tilting away into a histogram that is expanding down below its negative zero line threshold. We have weakness being inflicted upon some of these key technical momentum indicators. And I believe the line in the sand could be the 4 handle. Call it a minor price support level that has been deflected and respected upon multiple days here in a row. And upon taking that level out, you will drag and undercut the 50 handle under the relative strength index, only floating the idea of creating a much larger drop to retest and re-challenge its 50-day moving average. Its 618 fibs retracement, called the 3.80 price support level, called a duo price resistance level that long traders and or bull traders would need to defend heavily at all cost, rather than an additional bigger, much larger breakdown sell signal, ultimately undercutting that key inflection point out, undercutting its key psychological technical level within the 618 Fibonacci retracement level, ultimately re-challenging the biggest price support level in the near term off the 50% retracement, call it the 3.48 spot price. And that would be an additional 13.6% crash down to the 382 fibs if things get really bad, for a 22% crash. And the ultimate, call it the triple transitioning price support level in confluence of its 200-day moving average, its gap support, 236 price resistance level, and its primary reactionary uptrend price support level off the February reactionary lows of 2024. And that will be the biggest line in the sand gap, your 200-day moving average, your 236 fibs retracement, and your primary uptrend price support level. Make no mistake about it, that could be a big key inflection point for short sellers to cover profits, and or long traders. Bull traders would need to defend that key inflection point really at all costs to avert further technical damage that will outright hit the very foundation of trust and the momentum indicators, ultimately putting in a potential much larger, longer term interval sell signal in which you would only destroy the foundation of the technical structure of the commodity down to the ground. And what would really strike a lot of that key momentum is the ultimate near-term bearish scenario of getting that additional sell signal off a 22% crash with a lethal mix of geopolitical shifts, oversupply, and macroeconomic downtrending data. A potential surprise Russia-Ukraine peace deal could flood Europe with Russian gas, a crushing LNG demand, and forcing U.S. cargoes to reroute into an already oversupplied market. And we already have record high U.S. storage levels, sluggish industrial demand, and delays in LNG export growth amplify the supply glut. Add in a potential rally in the dollar, tighter credit conditions, and weakening global demand, and natural gas prices could very well, after initially putting in a much larger breakdown sell signal on the outer layers of the daily and or weekly, you could spiral down towards the sub $2 MMBTU, forcing shut-ins and a brutal market reset and a floodgate of levered longs rushing towards the emergency exits.